I'm here with Chris Heaman. He is a discretionary portfolio manager and he's been working in the financial industry since 1993. He specializes in volatility investing. So today we're going to cover inflation. Last week we talked about economic growth, but today we are talking all about inflation. What does it mean for the consumer? How do we measure inflation? And basically, what is inflation? So Chris, take it away.
Hi, Lisa. Great question. What is inflation and why is it so important that it's one of the things that we measure and we want to understand how it's impacting the consumer or yourself and I in the economy? Like you said, the last time we got together, we were measuring, when we talk about our macro model, what is economic growth? And this week, what I thought we'd start with is let's just take a look at that wonderful model that we've been going to that shows us the different areas that we could be in and how to invest. And on the one axis, we're trying to measure economic growth so that it helps us understand what's happening in the economy. Today, I'm going to touch on inflation and whether it's, is it growing or is it shrinking? Now, in a nutshell, inflation is the loss of your purchasing power on the dollars you spend in your economy. Okay, so when you go out and you buy something, it isn't actually that prices have gone up. It's more like the purchasing power of your dollar has eroded. But we measure inflation on what the cost of those things are. So, for example, just to age myself a bit, I always tell my kids that, when I was their age, 10, 12 years of age, I would spend 75 cents or 50 cents on a comic book. And that today is called a graphic novel, and it's $6 to $7. That's inflation. Okay. The cost of mailing a letter, for those of you that still do that, a stamp today costs 55, 65 cents. But back when we did it, it used to be 3 to 5 cents. So we see it as inflation as the impact of prices. But in actuality, what we're measuring is the loss of purchasing power of our dollars. Does that make sense?
Absolutely. Yeah.
Okay. And inflation's a tricky one. There's all sorts of different ways to measure it. So what I'm going to start with is we're going to take a look at the Canadian Consumer Price Index. Okay, and we'll take a look at that. What the Consumer Price Index is a way to measure inflation in our economy through what is the increase in the cost of goods. Okay, so the government sets out a long list. There's like 700 items in a basket of goods that they established. And here we're using a reference to 2002 is equal to $100. Okay, so now we measure it today and we compare it back to those same basket of goods in 2002. And on our chart here, it kind of shows that we're somewhere between $137, $138, somewhere in there. For the same basket of goods 18 years ago, we're now spending almost 38% more to buy those same things. Okay, seems kind of clear cut, but there's some nuances to this. Okay, some of those things that we buy are going to be larger, more productive, more efficient. So cars, for example, right? Today you spend $35,000 on a vehicle and you get more in it than you did in 2002. So how do we take that into consideration as a challenge for economists is what is becoming more efficient and more productive? If we're spending $1 and we're getting more things for it, more computing power. If you look at buying a computer 18 years ago and buying a computer today, right? The size of the computer 18 years ago now fits on your wrist if you own one of those fancy computer watches. So again, yeah, there you go. Our power, when we talk about the cost of goods sold, sometimes it's not so clean cut and it's very nuanced. Okay. Why is it important? Well, inflation means that things are costing more and some things are not in our CPI bucket, like housing, for example. Now, rent is and maintenance is, but actual housing prices going up, right? They're not increasing our inflation. So when we actually add in everything and we kind of pull from all these different sources, we can kind of see if the economy is growing and things are more robust. And the idea behind it is if you have an inflationary environment, you're also going to have job growth, labor growth, you're going to get paid more by your employer, you're going to make more. Okay, that doesn't always happen, and which is why we've been talking about what happens when we don't get economic growth but we get inflation. And that's where we talked about being in that orange category, that stagflationary environment, where we're stagnant with one side of the economy but we're inflationary in the other. Now, why would a government want inflation? That's the big key question. And why are the governments, and depending on what you measure, why do they measure things differently? In the States, they've recently changed their model to what's called a PCE inflationary number, which is a personal consumption expenditure number. Now, that's when fancy academics with PhDs and economists, they like to build these models that they think the whole world works by. And they change the way that they measure certain things so they can remove high inflationary costs out of the model. Okay. Now, right now, we have had a large amount of increase in the supply of money due to the crisis. So, what I was going to do is share, and we're going to talk a little bit more about economics, but I was going to share with everybody a chart that illustrates the supply of money in the system. Okay. Just bear with me here. There we go. Okay. So inflation has a lot of connection to how much money do we have in our economy and the supply of money. Now, I don't want to get too far down the rabbit hole with everybody, but there's a way to measure all the different areas of money, whether it's bank deposits, checking accounts, investments, all that kind of stuff, and debt. Okay. Government balance sheets. One of the big areas that governments measure is called M2 money supply. Just like anything else, if you have too much money, too much supply, right? You might have people chasing a very restricted amount of goods. Okay, when you have too many people wanting the same thing and wanting to buy the same thing, what happens is competitive pricing exists and emerges. Okay, so when we have a correlation effect, which is what is one of the ways that we measure inflation and what is it connected to, when we see an increase or a decrease of this indicator, of this measurement, how it affects inflation. And M2 money supply is one of the higher correlated things. The more supply we have of money, the more times that we end up inflationary. Doesn't always have 100%, but it is something that we pay attention to. So one of the reasons why governments want inflation is that if you hold a lot of debt and you have inflation, that's a good thing, okay? Because the purchasing power of your dollars are dropping, you're actually paying back less and less and less debt. Does that make sense?
Yes, yes.
It's kind of reverse of the comic book example, okay? So if we go back and we say, well, we spent 50 to 75 cents on an asset, something that we enjoyed, 30 years ago, and if we took out $6 in debt at the exact same time to buy it, today I'm only paying off 50 cents of that $6 in today's money because of inflation. Okay. And that's what we call a real rate of return. So when we talk about investments, we talk about rates of return, a lot of people are talking about what we call nominal, which is before inflation. So I got a 6% rate of return. Well, if you know anybody over the age of 50 and they were maybe in their 60s and they were telling you about their first mortgage, right? And maybe they told you the story about how mortgage rates used to be double digit at one time, okay? Back then, inflation was actually up around 12 to 15%, depending on the year you're looking at, okay? So your real rate of return was actually negative on deposits, and could be negative on your mortgage. Now, we don't actually see that in our mortgage rate. We don't actually get that benefit directly in our pocketbook. But what was happening is that the purchasing power of dollars, right, at that time was being lost due to inflation. And if you owed debt, that meant that your debt was actually decreasing when you measure it in real value. So far, so good?
Yeah. So just give us that, the formula for inflation. Just tell us again exactly what the formula for the real rate of return is.
Okay, so what you do is you take your nominal rate of return, and then you have to add in your inflation. Okay, so inflation is erosion. So your real rate of return is removing the inflationary number out of your nominal. If you get a 6% rate of return and you have a 3% inflationary number for the year, your real rate of return was 3%, 6 minus 3.
Perfect.
Okay,
Yes, exactly. Thank you.
no problem. So money supply has a very highly correlated connection to inflation. Okay. And why does the governments want this inflationary number to be higher? Well, if you've created money for getting through the crisis, there's only two ways to pay it back. Okay. If you take on a lot of debt, whether you're a person, a company, or a government, a sovereign nation, there's only two ways to get out of all of this debt. The first one is taxes. Nobody wants that. Okay. So they're going to charge you more to collect more, because that's the revenue of governments is taxes. So they're going to collect more from you so that they have more revenue so that they can pay back the debt. That's one way of getting out of it. The second way of getting out of it is to have it erode in value. Okay. So just recently, yesterday, which is a good day to talk to you today, because yesterday in the States, there was this guy named Jerome Powell, who is the head of the central bank of the States called the Fed. And he had this big press release yesterday, and they have this thing once a month. Well, once a month, but they have this thing where they come in called the Federal Open Market Committee, and they talk about the policies. It's really boring for most people, but if you're an economist geek like me, it's a great day to listen to what the central bank is doing. And what they've said is that they've changed the way they measure inflation, and they've changed the way their policies are around inflation. And what they're trying to do is they're trying to get the average inflationary number up over 2%, not the actual number month over month or year over year. They're trying to get that average inflation over a period of time up over 2% and let it run hot. That might mean you might get an annual inflation at 7% for 1 year. And the governments, under normal situations, they would change policy. They would increase interest rates. So if anybody remembers the 1970s and inflation started to get out of control, we had 12, 15% inflation, we raised interest rates, okay, to try and help compete against inflation. Now, if we raised interest rates today, the cost of our debts would all go up, especially the governments, because as this chart is showing, the supply of money, the amount of government debt has increased due to the COVID crisis. So all these governments, they have all this debt on the balance sheet. How do you get out of this situation? You let inflation run hot. That's the target. That's the new way of thinking. We want inflation. Now, what does that mean to you, the consumer? That means it's going to cost you more and more and more in the economy. Things are going to go up in costs. Some things, like we talked last time, your grocery bill. Your grocery bill, you buy meat, you might get less meat for more cost. Okay. You might buy a computer and you'll get more computing cost for less cost. It might be the reverse. Okay. But when you add up all of those things about, depending on the governments in Canada, it's about 700 different items, and you add it all up and you look at it, that's how they're measuring the overall CPI number. Okay. So that's your total, that's your bottom line. But in there, broken down, if you're not buying a brand new car this year, right, and you're still running your old car, maintenance costs have gone up, but you're not getting more value out of that car 5 years later or 1 year later. If you're buying a new car today, you might be buying newer, fancier things like having a nav screen in your car for the same price you paid for your car 5 years ago. So yeah, you get a fancier new thing. You might get leather seats, or you might get, a sports suspension. Those kind of things are deflationary, meaning you're getting more for the power of your dollar. Okay.
Okay.
But when you add that's just one little area of inflation. What the governments want is inflation to be hot, because that means all of the money is eroding in value and all of the debt that we now have is going down. That's the bottom line in a nutshell. It's as simple as you can make it. The governments want inflation. They're going to try and target inflation. They're going to let inflation run as hot as they can without it getting out of control. Now, inflation's like a wildfire, like we saw in California. Once it starts going, it can get really out of control depending on the conditions. Make sense?
Absolutely. So, okay. So now looking at inflation in regards to our portfolio and into investing, can you kind of give us, are there things that will help protect us against this inflationary environment?
Yes. So that's one of the keys is going back to our model is what can we do in order to make sure that we consider inflation and how it's acting in the economy and what can we own that's going to be inflationary protected. So as we talked about the last time, there are places like utilities, right? Real estate, commodities, okay? There's also things that are inflationary hedged, okay? So if you're buying bonds, you can buy inflationary hedged bonds. So you get your 1 or 2% nominal interest rate, but then you get what inflation is. Now, you're not going to get a hedge to real inflation. You're going to get a hedge to the government calculated inflation. And that's the understanding. That's where guys like me spend time saying, well, what is the methodology for them calculating? What is the model? How does the math work? Here's a really great example to help with that, just to give you an illustration of what the math can do and how it can create a different view. Okay.
Okay.
So this is just an illustration. This little chart is what we call M2 velocity. Now, there's a lot of academics that connect inflation to the velocity of money. And what the velocity of money is how much of our dollar is traveling through the economy. And what I tell people when I do these presentations is think about it. If you used a cash dollar, how many times would that cash dollar be moved from cash register to cash register throughout this entire economy through different hands? That's velocity. Okay. If money just sits and doesn't actually get spent in the economy, then there's not a lot of velocity. So what this little chart is showing is that the velocity of money is actually dropped. Okay. So for some people, they look at that and they say, well, there's a lot of deflation. The money isn't moving. We're not spending it. The consumer isn't out there buying new cars and buying new dresses and doing stuff like that. But really what you have to ask yourself is how do we calculate it? Because math can be tricky. And so what happens is we take the M2 money supply and we divide it by the GDP. Okay. So what can happen is if one thing changes in our math model, in our calculation, it can appear that things are slowing down just because maybe something dropped in value like GDP. Okay. And so it's really important that we don't just take these headline numbers and say, oh, inflation is not there. Okay. Or velocity of money has dropped, so there is no inflation. If you go to the grocery store, you will probably testify that there is inflation. Okay. If you are going to university, here's the great one, the great debate right now. If you were to go to Harvard University online and you spent $75,000 for your Harvard University degree, it's not the same experience. So that's an inflationary impact. You're spending the same amount of money, but you're not getting the exact same service. You're not getting the exact same product. Products are shrinking in size. Services are dropping in value, but we're spending more and more to achieve them. So there's medical costs, university costs, tuition. There's all these different places we can spend our money on. Now, in the future, we'll talk about what we work with clients. We help them create a personal inflationary number. Okay. We want to help you understand how is inflation affecting you personally and directly, and how can you be prepared for that in the future?
Okay. That's great. Do you have anything else you want to add to that?
No, that's about it for inflation. I mean, like I said, it's quite the economic.
It's complicated.
It's complicated. It's not that easy. And we read about it a lot. There's been a lot of articles out, mainstream media. The key here is interest rates are not going to go up unless inflation goes up. Governments have promised they're not raising interest rates. They can't afford to. Okay. Any government right now that's taken on so much debt, if they raise the interest rates to deal with inflation, they can't afford to make the interest payments to all the bond holders, the debt holders. Okay. So there's a direct connection to what somebody's liability is, like a mortgage, and somebody's asset. So the mortgage is an asset to the bank, but it's a liability to the holder. So when you get higher inflation, it puts a lot of stress on a system that's all designed around debt. And then interest rates go up, which costs us, the consumer, more interest on our debt to service, which takes away from us going out and spending money in the economy and buying new things. It's all interrelated.
Yeah, and that's great. And I think that's so important for everyone just to realize when it comes to their portfolio. There's so many moving parts to this conversation, and hence why we need an amazing portfolio manager to help guide us through these crazy times that we're experiencing right now. So thanks so much, Chris. I really appreciate that.
No problem. I look forward to the next time we talk.
Yeah, thanks so much. Have a good day.
You too.